Look past hot stocks like Nvidia, Tesla, and Microsoft, which are trading at sky-high multiples, and the market is full of wonderful businesses at fair prices, to quote the late, great Charlie Munger. Research Affiliates founder and chairman Rob Arnott thinks investors should turn their attention back to those businesses. He joins us to explain why. Hey, Rob, it's great to see you again.
Great to have a chance to chat.
All right, so you're an expert in the way market cycles will favor different asset classes at different times. Over the past 10, 15 years, it's been all about big tech stocks. And that means that some of these cheaper, maybe more mundane businesses have been doing very well as businesses, but investors have ignored them. You think this is a great opportunity for investors to take another look?
Yeah, actually, it's interesting. Some of the winners of the first tech bubble back in 2000 have grown handily. Qualcomm has 60 times the earnings that it had in the year 2000, 60 times. And yet its price is up by less than the S&P 500 over the last 23 years. You've got Cisco and Intel priced at very reasonable multiples. These companies run the plumbing of the internet. So this looks to me to be a wonderful opportunity to pivot into value. Value's been crushed this year. Russell growth has beat Russell value by 30 percentage points year to date. When that happens, temptation, human nature conditions us to say, get me out of here. But a more sensible approach is to ask, are the underlying businesses doing fine? If they are, this is a bargain. This is a time to pivot. This is a time to, at a minimum, rebalance, top up our value exposure, and more likely than that, actually proactively move to an overweight.
So here's the thing, Rob. We could have had this conversation 2 years ago. The same things you said would have been true. What is it on the horizon that makes you think 2 years from now we can't have this conversation? Some of these stocks will finally get a bid.
Well, firstly, if we'd had the conversation 2 years ago, the conversation would have been spot on because value did rebound handily. Late 2000, early 2000, late 2020, early 2021, value work performed brilliantly. Then it gave it some of it back by the end of 21. Then 2022 was a stupendous year for value. So what's happened is this narrative about AI reinventing our world. Narratives have the advantage of being mostly true, but the disadvantage of being entirely reflected in share prices. So share prices already reflect the entire narrative. And so for the AI and tech names to outperform the market from here, the technological revolution that they embody has to be even bigger than the current narrative would suggest.
So let me ask you, at the risk of asking you to talk your book, what paid off well then, and more importantly, what do you expect to pay off well in the future? How can investors get access to this kind of a strategy?
Well, one of the best ways to get access to value is a concept called the fundamental index. Research Affiliates Fundamental Index, or RAFI, is a product that has been embraced by a number of major investment platforms. PIMCO, Schwab, Invesco, all have multiple billions, 10 to 50 billion each, in fundamental index-based strategies. And fundamental index doesn't take the value stocks and then capitalization weight them the way most value indexes do. It takes the entire market, including the Nvidias, and says, let's weight companies by how big their business is. Nvidia's not got a very big business, so it doesn't get a very big weight. The market thinks that future business will be stupendous, and it might be, but you're already prepaying for a stupendous, huge business that may or may not actually take shape. So fundamental index is my favorite way to access value. Over the last 16 years, fundamental index has beat the conventional value indexes by anywhere from 30 to 50% over the last 16 years. That's 2 to 3% per annum compounded incremental return, with just as much value tilt as the value indexes.
And to be clear, Research Affiliates does not actually create mutual funds or ETFs. You sell your research to Schwab and Invesco and others that do. I know Invesco's got a small cap version of that strategy as well.
We're probably the only $130 billion asset manager that doesn't run money.
All right. Thanks so much, Rob. Thanks for joining us from sunny Florida. We appreciate it.